Hello, social. I was gonna actually post like more videos yesterday, but that whole New York news, it didn't really put me in a content making mood. But anyways, I'm back today with important topics about the market, or important to me at least. So I haven't really been watching the news this past week, but I did read a bunch of articles where I thought this is like BS, because I guess the writers, they were comparing this market downturn with the dot-com bubble and the recession of '08, and saying that, oh, this is the worst one so far in history, and comparing just absolute terms, which really doesn't make sense to me, because it's kind of like saying, yo, my stock went up $2 today. Okay, like, what is $2? Was it $10 and it went up 20%? It's 12 now. Or is it $100 stock and it went up 2%? And that's exactly how people are comparing this with previous times. So I started by diving into the numbers, but then I got a little deeper. So it's going to be a little longer. And I know last time I was talking about, like a little over a week ago, I was talking about the Nasdaq 100, not the Nasdaq Composite Index. But please keep in mind, sometimes I'm just taking a nap, waking up, looking at my charts on TD, and that was the chart that was open, the Nasdaq 100. Today I'm actually looking at the Nasdaq. But anyways, some differences between this and the dot-com bubble, okay? So the S&P this time around, from the high made in January to the low, we don't know if this is the low or not, but the recent low just this past week, it was about a 1,000 point decline, which is 19.91%. In 2000, it went from 1552 to 768, the low, which is a 50% decline, okay? So 19.90, 20% versus 50%. Now, the Nasdaq, on the other hand, topped out in November at, the low, we don't know if it's the low or not yet. From high to low this time around, 31.4%. In 2000, 78% decline from high to low. So 31% versus 78. How dare you even compare the two, It means that there is room to go lower, right? But still, like, we're not even there yet in terms of percentages, which is how things should be looked at. Now, I also looked at '07, '08, and the S&P went down 57% from high to low, 57.69, and the Nasdaq 55.77. Like, again, like, how dare you compare the two in articles? We're only down like 20% on the S&P and 31% on the Nasdaq. The the iPhone and all this extra revenue weren't even introduced until '07, which makes sense. All this extra market cap, Nvidia, the semiconductor chips, they weren't even there, right? So it makes sense that we got all this extra market cap across tech and across all these companies in general. So when we look at things, we should definitely be looking at percentage so we can compare right. What does this mean? Well, in my eyes, it means if there is a recession, then yeah, these are the kind of percentages that we're going to probably be looking at. But I don't think it's going to be like that, because we have to keep in mind each time is different, and I'm going to go over some of these details. This time we have to remember inflation, what caused it, and what's going on. It was a combination of two things. It was not movement along the demand or supply curve. It was, one, a shift in the supply curve, and natural disasters cause these things, or something insane. And it was COVID. It was like a black swan, natural insane event, kind of like a natural disaster. It shifted the supply curve to the left, a shift. And then we pumped up the economy with stimulus, too much in my eyes, for some individuals. And that shifted the demand curve to the right. So it just made things so worse. Like, usually these shifts don't occur together, when you study these things. But anyways, here's why I think these things are different. So if you look, for example, at the '07, '08 crisis, we had a 57% decline and a 55% decline in the S&P and Nasdaq respectively. The financial system was weak. The companies were weak. They weren't selling. This time around, so far it's only 20% in the S&P 500, and 31% where there was a lot of froth in the Nasdaq, right? So our top 500 companies are really strong, you know. The .com on the other hand, you know, and I was surprised. I didn't even know like the Nasdaq went down that much. We had 50.5% in the S&P and 78 in the Nasdaq. Like that's pretty insane, you know. And that's because the Nasdaq was overvalued. This time around, the companies are strong, you know. I don't think it's gonna be nearly as bad. In fact, I think I don't want to call a bottom, but I think we are close to a bottom. If a couple of things hold, if the supply chain doesn't get worse, like a lot worse, or there are no unforeseen events, I think that, yeah, sure, inflation is sticky. We'll have it for a little longer. I don't think it's going to be at 8.5 or 8%. I think it'll come down because there is demand destruction going on. I hope some of the supply chain is getting fixed, but it'll, you know, 4 to 6% inflation isn't a big deal for an economy that's still growing, you know. But here is another thing that I looked at. I was looking at some ratios, like I was looking at the Nasdaq to the S&P. Like each time is different. I don't know why everyone like keeps comparing them. Like this time around, then in percentage of losses, Nasdaq to S&P ratio is 1.58. In .com it was 1.55, and in 0708 it was 0.96. So in terms of these ratios, like, and I also looked at the Russell because that was pumped the most relative to the S&P. Again, 2000s 0.94, 0708 1.04, today 1.5, which is way higher than the rest by like 50%. So I think a lot of this overvaluations, they already came offline, the market isn't as overvalued as people are saying it is. And again, this time is different because in the 2000s and in 0708, usually these markets, when they make a top, they're making a top either on the same exact date or like a day apart, you know. Like I think in the 2000s it was like one made a top on Friday and the other on Monday or something like that. But this time around, the Nasdaq actually topped on November 2022 of 2021, whereas the S&P topped in January 4th of 2022, and the Russell topped even before the Nasdaq. So it's a little bit different this time around, and it is because of the tech overvaluation, right? But a lot of these metrics and ratios are saying a lot of that froth already came out, you know, and negative, and sentiment is the most negative since March. I read that March of 08. Well, that's when or March of 09, I think. That's when some of the things started. That's when there was actually a bottom. And again, I'm not calling a bottom here, but I still believe that things are not as bad as people making them out to be, you know. And I actually spent like maybe an hour to make sure the numbers are right on this one. So I guess we'll see moving forward, but people should not compare this to the 2000s or 07, 08, because the infrastructure was weak then, you know. The financial system was weak in one of them, and the other one, there was a bunch of BS companies out there. Yo, the companies right now in the Nasdaq and the S&P 500 are not BS companies. Lots of them are real companies with real earnings. And if you look at percentage terms versus absolute terms, no, we're not like anywhere near that. I mean, I hope I'm right about that. Of course, I could be wrong, but I hope I'm right. So, you know, we could actually start recovering again, the markets, you know. But anyways, that's today's topic. It's a little longer, but I did look at all these different things, and that's just one point of view. We'll see how things go. Even with all the negative sentiment, my point of view did not change. Are there companies out there still overvalued? Yeah, for sure. There are some BS companies, but the majority are not like that. Sentiment is too negative in my eyes. But yeah, that's today's topic.